Welcome back to Block2Learn. This week, the market is sending a message that many investors may not want to hear. Prices are moving, headlines are loud, and narratives are still powerful. But beneath the surface, something more important is happening. Capital is becoming more selective. Investors are no longer rewarding every story with the same enthusiasm. They are no longer buying scarcity just because access is limited. They are no longer treating innovation as an automatic justification for any valuation. And they are no longer assuming that every geopolitical headline must produce the same market reaction. The market is not simply reacting to news. It is repricing liquidity, scarcity, valuation, and execution risk. That is the dominant narrative of the week. And to understand it, we need to look beyond one asset, one headline, or one chart. We need to connect the dollar, equities, Bitcoin, commodities, private markets, Ethereum, strategy, SpaceX, and institutional crypto adoption into one broader framework. Because the real story is not that markets are weak. The real story is that markets are becoming more demanding. The first signal comes from the dollar. The US dollar index has broken higher with strong momentum. RSI is elevated. MACD remains constructive, and price is trading above key moving averages. This matters because the dollar is not just another chart. It is one of the most important pressure points in the global financial system. When the dollar strengthens aggressively, global liquidity tightens at the margin. Foreign currencies come under pressure. Commodities often struggle. Emerging markets face additional stress. Risk assets become more sensitive to funding conditions, and speculative capital becomes more disciplined. This is why investors cannot analyze crypto or equities in isolation. A stronger dollar changes the cost of risk. It does not automatically destroy risk assets, but it forces the market to become more selective. It raises the standard for what deserves capital. It pressures assets that rely heavily on future growth, loose financial conditions, or narrative-based valuation. And that is exactly what we are seeing across markets. The S&P 500 and Nasdaq remain elevated after a powerful rally, but momentum is no longer expanding with the same force. Both indices are still above their long-term moving averages, which means the broader trend has not fully broken. However, the short-term structure shows hesitation. The S&P 500 has moved below its faster-moving averages. The Nasdaq is also losing momentum after leading the previous advance. RSI readings have cooled, MACD is weakening, and price action suggests that investors are no longer buying every dip with the same confidence. This does not necessarily mean a major equity correction is starting, but it does mean the market is transitioning from expansion to evaluation. The Dow Jones looks more resilient, supported by a broader industrial and value-oriented structure. But even there, momentum is not accelerating aggressively. The message from equities is clear: the market is not collapsing. But it is no longer easy. This is where many investors make mistakes. They assume that as long as prices are high, risk is low. In reality, the opposite is often true. When markets are extended, liquidity matters more, valuation matters more, execution matters more, and disappointment becomes more expensive. That same message is visible in commodities. Gold and silver are both under pressure. This is especially important because geopolitical uncertainty remains present. In a more traditional market reaction, investors might expect gold to attract immediate safe haven demand. But instead, gold has failed to hold momentum and is trading below important moving averages. Silver looks even weaker, with price breaking lower and momentum deteriorating. This tells us something important. The market is not blindly buying protection. It is filtering risk through the lens of liquidity and the dollar. When the dollar is strong and real liquidity feels tighter, even traditional defensive assets can struggle. Investors may still want protection, but they are not willing to pay any price for it. Oil is also weakening. WTI has moved lower, sitting below its key moving averages. While RSI remains weak and MACD continues to reflect downside pressure. Again, this is not just about oil. It is about the broader message. If geopolitical risk were the dominant force, energy could have reacted differently. Instead, the market appears more focused on demand, liquidity, and dollar strength. This is the first major lesson of the week. Headlines create noise. Liquidity creates direction. Now let us move to Bitcoin. Bitcoin is the most important chart in the digital asset market right now because it sits directly between two narratives. On one side, Bitcoin is showing relative resilience. It has not collapsed despite geopolitical uncertainty, equity hesitation, and a stronger dollar. The market briefly tested lower levels but did not enter a full panic phase. That matters. It suggests that Bitcoin is no longer behaving purely like a retail speculative asset. A growing portion of the market appears to be held by longer-term investors, institutions, treasury structures, and participants who are less reactive to daily headlines. But the second side of the story is equally important. Bitcoin is not showing strong upside confirmation. Price remains below short-term and medium-term moving averages. The area around $60,000 remains a critical psychological and structural zone. RSI is weak, MACD remains under pressure, and the chart still reflects a market trying to stabilize rather than a market already expanding. This is a crucial distinction. Stability is not strength. A market can stop falling before it becomes bullish again. Bitcoin is currently telling us that capital has not abandoned the asset, but it is also not fully returned with conviction. That is why the next phase is so important. If Bitcoin can defend the lower structure and reclaim key moving averages, it may confirm that institutional accumulation is absorbing macro pressure. But if the dollar continues higher and risk appetite weakens, Bitcoin may remain trapped in a defensive structure for longer. The mistake would be to reduce this to a simple bullish or bearish statement. The better framework is this. Bitcoin is being tested as a mature macro asset. In previous cycles, the market often reacted emotionally to every headline. Today, Bitcoin seems more connected to liquidity, capital flows, institutional positioning, and global risk appetite. That is a sign of maturation. But maturation does not eliminate volatility. It only changes the reason behind it. Ethereum adds another layer to this picture. The recent large Ethereum short position attracted attention because of its size. Reportedly more than $72 million near a sensitive technical area. But the real importance is not the trade itself. The trade matters because it exposes the debate beneath the market. Ethereum is caught between recovery and confirmation. Buyers have defended important support zones, but the market has not yet delivered the kind of breakout that forces bearish positioning to unwind. This creates a fragile environment where one side sees accumulation and the other side sees exhaustion. The most important question is not whether one whale is right. The real question is whether liquidity is returning to the digital asset sector with enough force to support a broader expansion. Large short positions can become future fuel if the market moves against them, but they can also accelerate downside if support fails. That is why Ethereum remains a key sentiment barometer. It reflects the uncertainty of the entire crypto market. Now let us connect this to institutional adoption. Franklin Templeton's expansion into crypto shows that institutional digital assets are moving into a new stage. This is not just about passive exposure anymore. It is about actively managed strategies, tokenized assets, portfolio construction, and institutional infrastructure. That distinction is essential. The market often focuses on price. Institutions focus on rails. While retail investors debate the next candle, major asset managers are building the infrastructure that could define the next decade of digital finance. Franklin Templeton's Benji platform, with billions in tokenized assets, shows that tokenized finance is no longer a theoretical concept. It is becoming a real part of institutional capital markets. Even more interesting is the behavior behind the data. If tokenized assets increase while transfer activity declines, it may suggest that capital is not merely trading these instruments. It may be holding them. That is how markets evolve from speculation to infrastructure. This creates an important contrast. Short-term crypto price action remains fragile. Long-term institutional infrastructure continues to expand. Both can be true at the same time. This is where most investors struggle. They want one clean answer. Bull market or bear market, adoption or rejection, strength or weakness. But markets are often more complex. The same asset class can experience short-term liquidity pressure while undergoing long-term structural adoption. Understanding that distinction is one of the key reasons why a structured framework matters. That is also why we always connect these events through the Block2Learn learning path on block2learn.com. The goal is not to chase more information. The goal is to understand what the information means. Now, the same framework applies outside crypto. SpaceX is one of the clearest examples of how markets are repricing scarcity and execution risk. For years, SpaceX has been one of the most desired private companies in the world. It represents reusable rockets, Starlink, satellite infrastructure, defense contracts, global connectivity, artificial intelligence infrastructure, and long-term space optionality. The narrative is extraordinary, but even extraordinary narratives must face valuation discipline. Recent weakness in tokenized SpaceX exposure, with a decline exceeding 25% from recent highs, shows that scarcity alone is not enough when liquidity becomes more selective. This does not mean SpaceX is a weak company. That is not the point. The point is that markets often confuse business quality with valuation risk. A great company can still become expensive, a powerful narrative can still be overextended, and a scarce asset can still correct when investors begin asking harder questions. How much growth is already priced in? How much execution risk remains? How much future profitability is assumed? How much premium should investors pay for limited access? SpaceX forces the market to confront all of these questions. At the same time, investors should not evaluate SpaceX only as a rocket company. That may be the wrong framework. SpaceX is increasingly a multi-layer infrastructure platform. Starlink creates recurring revenue through global connectivity. Artificial intelligence infrastructure may become a major future growth engine. Starship could reduce launch costs and unlock new economic models. So the debate is not simple. SpaceX may be expensive, but it may also be misunderstood. The correct approach is not emotional, it is structural. Investors need to separate narrative, valuation, execution, and optionality. That is exactly the kind of thinking required in today's market. Strategy, formerly MicroStrategy, gives us another example. Strategy has become the largest public test of the Bitcoin Treasury model. The stock is no longer evaluated like a normal software business. It is a hybrid structure, combining corporate finance, Bitcoin exposure, equity market liquidity, debt sustainability, and investor confidence. When Bitcoin rises aggressively, the model looks powerful. When Bitcoin consolidates or declines, the model enters a stress test. The weekly chart reflects this pressure, and the market is questioning whether the premium assigned to the Bitcoin Treasury model is still justified. This matters far beyond one company. Many companies have begun adopting Bitcoin Treasury strategies. During bullish phases, these models attract attention because they appear to create shareholder value through Bitcoin appreciation. But the real test comes during difficult periods. Can these companies maintain investor confidence? Can they raise capital efficiently? Can they manage dilution concerns? Can the market continue rewarding leveraged Bitcoin exposure when volatility rises? Strategy is the blueprint, but it is also the stress test. And this connects directly back to the broader theme of the week. The market is no longer rewarding narrative alone. It is asking for durability. It is asking for liquidity support. It is asking for execution. It is asking whether the structure can survive pressure. This applies to SpaceX. It applies to strategy. It applies to Ethereum. It applies to Bitcoin. It applies to equities. It applies to commodities. Across the entire market, the same question is emerging. What deserves capital when liquidity becomes more selective? This is the most important investor implication. The next phase of the market may not reward those who simply chase the strongest story. It may reward those who understand how capital moves. When the dollar strengthens, the market becomes less forgiving. When equities lose momentum, risk appetite becomes more fragile. When commodities fall despite geopolitical uncertainty, the market is telling us that liquidity may matter more than headlines. When Bitcoin holds but fails to confirm strength, it shows resilience without full conviction. When Ethereum attracts aggressive short positioning, it reveals uncertainty beneath the surface. When Franklin Templeton builds deeper crypto infrastructure, it confirms that institutional adoption continues even during volatility. When SpaceX corrects, it shows that scarcity premiums can be tested. When strategy weakens, it shows that Treasury models must survive more than bull market enthusiasm. This is not a market of simple answers. It is a market of filters. The investors who rely only on headlines may see confusion. The investors who look through liquidity, valuation, execution, and capital flows may see structure. That is the real message of this week. Markets are not rejecting innovation. They are repricing the cost of believing in it. Markets are not abandoning Bitcoin. They are testing whether Bitcoin can behave like a mature macro asset under pressure. Markets are not ending institutional crypto adoption. They are separating infrastructure from speculation. Markets are not ignoring geopolitical risk. They are asking whether that risk actually changes. Liquidity, policy, or capital flows. This distinction is everything. Because in financial markets, the question is rarely what happened. The better question is what the market is choosing to care about. Right now, the market is choosing to care about the dollar, liquidity, valuation, and execution. That is why the current environment feels uncomfortable. It forces investors to stop thinking in narratives and start thinking in frameworks. And that is exactly the purpose of Block2Learn. Not to give predictions, not to chase noise, but to help investors build a structured way of thinking about capital, risk, opportunity, and decision-making in a complex market environment. You can explore more through Block2Learn.com. The next phase will not belong to investors who collect the most headlines. It will belong to investors who understand which headlines actually matter. Information is abundant, structure is rare. Start from the free start. There is no reason to wait any longer. Begin your journey today. Block2Learn. This video is for informational and educational purposes only and should not be considered financial advice.